Alright, there we go. Screen up, our website. Alright, so here we're going to build just a random stock portfolio. And this is just going to show you, the power of how to build a portfolio, why it really doesn't matter what companies you pick, as long as you understand rebalancing, right? And rebalancing, what it does is it's going to allow you to manage your portfolio, and you just do it once a year. You can do it more often, but the more often you do it, you start to be a micromanager. And whenever you start to micromanage things, it doesn't work out as well as it should, right? So our goal is to beat VU because that's the new standard that everyone, is telling everybody to buy. And we're a new investor, so we're going to cash flow $200 a month into our portfolio. We're going to rebalance annually. Well, that's Jello. You going to get you some?
I need one.
You going to get you a Jello? Here.
Jello.
Okay.
Yummy. Jello.
All right, you can get you one.
Jello.
Okay, there's your Jello. That's your trash. Put it in the trash.
Jello.
Yeah, that's trash. Okay, so we're going to contribute $200 a month. We're going to rebalance annually. And rebalancing is how you manage a portfolio, right? This is why what stocks you pick don't really matter, is because you're going to be rebalancing them. And the rebalancing, what it does is it's going to allow you to lock in gains of companies that ran up and transfer those gains over to companies that haven't run up, right? And what that does is over time is it allows you to buy dips, right? It allows you to buy dips, and you're basically, think about it kind of like walking up the stairs, one leg at a time, right? But with a portfolio, you're gonna be like a centipede. You're gonna have 10 legs because you have 10 different stocks. And some go up, and you got to drag the other one back up, right? But you're just walking up the stairs, right? And so we're going to go to this map here and look at, what companies are out there. Like, maybe I don't know what company to buy. Maybe I've heard of some, but I forgot names of others. And, I've been told you got to diversify, right? And so what does that even mean, right? There's many different ways and understandings of what it means to diversify. But we're going to just pick from different places. Like, you have technology, consumer goods, consumer defense, we have industrials, communications. We're just going to pick, right? We're going to pick whatever. And we're not even going to go with we're just going to pick stuff, right? So we're going to pick here's technology. It looks like Oracle is a pretty good company. Everyone knows who Microsoft is, but Oracle, maybe I should go with them, or Palantir, or Adobe, or Palo Alto Networks, right? And maybe I'll go with this one, Palo Alto Networks, PANW. So let's go. We're gonna pick that one, right? We're gonna pick that one, right? So we have Palo Alto Networks. There it is. Right, and so we have our technology. All right, we have that one. Consumer. We're gonna go with Home Depot. Right. We'll go with Home Depot, and we're gonna go with we're gonna pick McDonald's. Pick McDonald's because I like McDonald's, right? McDonald's, you know, like McDonald's. And we come over here to beverage, or to, you know, what's this one? Discount stores, right? Consumer defense. We're going to go with Walmart, WMT. WMT, you know, we're going to get Walmart. And we're going to get we're going to buy some Coca-Cola. Right, well, maybe, you know what, we're going to go with Pepsi. Pepsi. PEP. Right? PEP. We're going to go with Pepsi. So we got some Pepsi, some Coca-Cola. You know, maybe you're a smoker, so you're going to go with Philip Morris, you know. What is it? MO. No, I'm not even gonna look. Well, here's one. Caterpillar. We're gonna get Caterpillar farm equipment. So we're gonna get into some farming. Go with some Caterpillar, right? And we're gonna keep looking. And telecommunications. We're gonna go with T-Mobile. Look at that, T-Mobile. Look, I guess that's bigger than other ones. We're going to go with T-Mobile. What is it? T-Mobile. We're going to get some T-Mobile. Right? And we're going to get into some utilities, right? Actually, you know, we're going to get into a railroad. How about that? We're going to get a railroad. We're going to go with... We're going to go with Union Pacific. UNP. Alright, we're going to get a Union Pacific in there. We need two more, right? We need two more. Alright, so we're going to go with healthcare. Look at this. Eli Lilly, right? I guess that's the biggest healthcare, right? Yeah, we'll go with the big dog. Eli Lilly. You know, health is important, right? So we get some Eli Lilly. And we got to get financial, right? So we're going to go with MasterCard. All right, MasterCard. All right. And all you do is, you, like I said, you got 10 companies, allocate them 10% each, right? Like, don't make it more complicated than it is. You just balance it out, right? You just want to balance it out, right? And with a balanced portfolio, you know, first you're diversified just because you have 10 different companies, right? So that's diversified in and of itself. But you're diversified even more because the companies are in all kinds of different sectors, right? So it's a heavily diversified portfolio. It's just a hodgepodge of just random companies that we went and picked. Right? And we're just starting investing. We're going to rebalance once a year. So every paycheck, you know, or once a month, you know, every paycheck we're buying $50 to $100 worth of stock, or $200 a month, right? And that's what we're going to do. Let's see, how did we perform? Right? We're going to see how did this go, right? And we're going to close them down and look at that. We made, you know, $69,800 is now how much we have invested in our portfolio. And the VU investor is at $49,700. You know, so I mean, we completely blew by this guy, right? Completely blew by the S&P 500 investor, who, you know, people want to say that it's impossible to beat this, you know, and that 90% of investors don't beat it, right? The reason they don't beat it is because they're not investors, they're traders. They're gamblers, right? They're not investing, right? Look at this portfolio as you're a business owner. These are your businesses that you own, right? and you're sending your money off to work at these businesses, right? And sometimes they don't do, sometimes they get sick, or sometimes machinery breaks, you got to repair it. So that, they're going to have ups and downs, right? Sometimes, maybe McDonald's made way too many hamburgers, right? And so they made a whole bunch of hamburgers. They shot up, and then people stopped buying McDonald's, and now they have way too many hamburgers, and so the stock is going back down, right? You don't just get rid of the company because of stuff like that, right? You just pick your companies. You can pick what you like, or you can pick something random, like this is absolute random. I mean, there's a unlimited amount of ways you can build a portfolio, and you just stick to an allocation of 10%, and you rebalance once a year. Put them back to 10%, right? And let's see how these companies performed, right? Now, no, see, look at this, right? Not only did we outperform, the S&P 500, we took a lot less risk, right? Lost, drawdown, right? Like they had a 17% drawdown, we had an 11, so we had a lot less volatility than these cats, and you can see, here we go, we just started taking off, right? We just started taking off from these guys, you see. And we can come down here and we can look at how the stocks performed. So you have Palo Alto Networks returned 7,000, and Home Depot 2.9, McDonald's 2.2. Look at this Walmart, $5,000, right? Pepsi 800. Look at this, right? Eli Lilly at $9,000, right? MasterCard at 4. And people will think that, like, well, why don't I just buy more Eli Lilly, right? Just why don't, if it's so performing, why would I sell it, And listen, like the more money you have in it, like the bigger your allocation, if it's not balanced, right? If this is 20%, yeah, it might have returned, more, right? But you also have more to lose. That's why you want to keep it balanced. You want to just balance it out, and just that's all you do.